various things. One, perception that the stock market is no longer a great risk reward asset. It's now a risk asset. Okay. And once they become aware of that by getting kicked in the shins and then in the gut, as we're seeing, even today as we're speaking, we're getting clobbered again in the stock market. What this shows is simply over since 2020. Remember back in the summer of 2020, we had a big upside move in gold, silver, and the miners. And in that time, gold shot up versus the stock market. Relatively. It got up to a 60% level, meaning the price of an ounce of gold was 60% of the price of the S&P. Okay. And then it pulled back. And since 2021, early 2022, it got down under 40%, like 37 and a half, and it shot up again and lived mainly around the 45% level, but in a range, technical, clear range. Bumped the top of that range at about 47, 48%, about 4 times. It's like a ceiling. Well, last month marginally closed out above it. And this month, intra-month, you're well out above it, which is that last reading. So what it tells us is that technically gold is shifting to an outperform mode versus the S&P. We thought that would occur simultaneous with the breakage in the stock market. So it's not merely a function of gold holding steady and moving up, but the stock market going down as well. Well, that, of course, catches the attention of asset managers if there's another place to be. And they've historically gone to T-bonds and gold, 2000 to 2002, 2007 to 2009, they moved into those assets. Right now, T-bonds are getting a rally, and I think it's largely because of the sense of danger in the stock market. But gold has been outperforming both widely, as you saw in that chart. It's not just the last few months, but last couple of years, it's well off that low. So that indicates there is a shift underlying, even though they're not beating the table about it.
What part of the stock market is, let's say, most fragile at this point? We see this outperformance, and we just went over that chart of gold to the S&P. But what about something like the NASDAQ? NASDAQ has had a lot of speculative money flow into it.
Yeah, it was the leader on the upside. It'll be the leader on the downside. This was the case back in the dot-com period where the S&P dropped 50% between 2000 and 2002. NASDAQ 100 went down 82%. Okay, it had led on the upside, the leader on the downside. The same is true this time. Since 2009, the NASDAQ 100 went up about 18-fold to its highs a couple of months ago. S&P went up about 8-9-fold. So you can double the performance of the S&P. The downside will be the same. However, don't take your eyes off of other sectors. I know everybody's focused just on, the big 7 thing, and NVIDIA. Watch the banks, watch commercial real estate. When you create a stock market bubble of that duration and dimension, we've never had one like this in U.S. stock market history.
It's funny how quickly perceptions shift in markets. One minute you're at the top of the world, watching the S&P 500 and the NASDAQ hit euphoric highs, and the next you're ducking from falling debris in what was supposed to be the everything bubble. The key shift we're watching right now, and I want our audience to really grasp this, is the pivot from stocks being seen as a safe bet to becoming recognized for what they actually are, a risk asset. The glitter is wearing off, and investors are beginning to realize that the real protection is in assets that don't rely on momentum and central bank hallucinations to hold value. The outperformance of gold relative to the stock market, especially the S&P, over the last few years has been substantial, and yet it's still largely flying under the radar of most mainstream investors. Back in 2020, gold shot up versus the S&P during that summer surge. The ratio of gold to the S&P 500 touched 60%, meaning 1 ounce of gold was worth 60% of the S&P index value. That was no small feat. Then came the pullback, the consolidation, and for the past couple of years, we've hovered in a technical range between about 37% and 45%. But now we're breaking out above that range. We've hit the ceiling multiple times, and just this month, we're pushing above it decisively. That tells me one thing. Gold is entering an outperformance phase, not just in price terms, but in relative value compared to equities. We saw the same thing in past cycles, 2000 to 2002, 2007 to 2009. Every time stocks have collapsed, smart money has rotated out and found shelter in gold and treasuries. This isn't just a chart pattern, it's a behavioral pattern, and it's unfolding again right now. Now, when we talk about the current fragility of the market, People naturally think of the NASDAQ and the Magnificent Seven tech stocks, Apple, Nvidia, Meta, and so on. That's where the speculative froth is. It's where we've seen the biggest upside, and as always, it's where we'll see the most pain on the downside. This is classic bubble dynamics. In 2000, the NASDAQ dropped over 80%. The S&P dropped 50%, but the NASDAQ was the poster child of excess, and it paid for it dearly. Same dynamics today, folks. NASDAQ up 18x from 2009 highs to recent peaks. That's a setup, not a victory lap. But don't just focus on the surface. There's more. Look at commercial real estate, the banking sector, credit conditions. These are pressure points that are beginning to fracture. Remember, this market has been artificially inflated by over a decade of ultra-loose monetary policy. We're talking near zero interest rates for 10 out of the last 15 years, QE to infinity, and more liquidity injections than your average casino. What that's done is created massive misallocations of capital, inflated asset values beyond reason, and fostered a false sense of security. Now that the Fed has taken its foot off the gas, people are starting to realize that the returns they were chasing weren't real. They were manufactured. They were monetary hallucinations, and the high is wearing off. So here we are. Asset managers are beginning to wake up, and they're realizing that just like in 2000 and 2008, the exits get very crowded very quickly when sentiment turns. You want to know where the smart money's going? It's going to T-bonds and gold. But here's the twist. Treasuries don't have the same allure they once did. Why? Because the U.S. debt picture is worse than ever. We're talking about $34 trillion in national debt, rising interest payments, and a central bank caught between a rock and a firestorm. So while the bond market might get a bid short-term, gold is the real beneficiary this time around. And look, I'm not saying this out of ideology. I don't wear a gold is money t-shirt on the weekends. I'm saying this because technicals confirm it, the flows confirm it, and the macro confirms it. We've been tracking the gold to S&P ratio closely. It's a powerful long-term measure of relative performance. What we're seeing now is a clear structural breakout on the long-term momentum charts. This isn't noise. This is signal. This is institutional reallocation happening before your eyes. If you're a retail investor, you might not have noticed yet. But the institutional players, they see it. They might not talk about it on CNBC, but their trades are doing the talking. Gold is resuming leadership, and it's doing so at a time when the entire market structure is vulnerable. The cracks are showing not just in equity valuations, but in the very trust of the fiat system. Think about it. We're in an environment where central banks themselves, who hold the keys to the fiat kingdom, are buying gold at record pace. Why? Because they see what's coming. They see the risk in debt, in credit markets, in currencies. They are front-running the crisis, shouldn't you?
That many years up with that much dimension, caused, no doubt, by monetary policy. QEs ad infinitum, Fed funds rate at 0 for 10 of the 15 years, et cetera. No wonder you had a big bull. It creates errors. Creates stock market errors, it creates investment errors, it creates corporate spending errors, family spending errors. And when it breaks, when they rip the bandage off and take the needle out and you don't know no more hallucinogenic drugs, it goes to hell. And that will lead. But debt is a problem, not just government debt, but okay. So you got to watch that sector as well. But generally, the leadership on the downside will be what had led the upside. That's the NASDAQ 100.
And as we see on this chart, momentum is kind of breaking a bit of a structure.
Last week, yeah. That on the price chart, now, by the way, that red line on the price chart is a 3/4 moving average. What we do is we average the prior three quarters of action and come up with an average, and that average applies for the next quarter. So it only shifts once a quarter. On the chart in the bottom, in their relationship to that average, you have a flat floor that's been hit 1, 2, 3, 4 times in the past year plus. Okay? You broke it last week. So we finally pulled that plug. And right now we're down below the zero line as well this week. So it's starting to really come apart. This is a long-term metric. And when it breaks, it means business. So as far as we're concerned, top is in place. The only issue now is not whether you're going to get a bear market, but the nature of the bear. Does it crash? Possible, unlikely. More likely, we're going to find next support of any consequence where you get a bounce that people might notice. Historically, 1987, the COVID crash, all 35% in a matter of a couple of weeks. Okay, not 10, 12% slabs. So we could slab our way down seriously without crashing. And I think the next support is, like I said, while we're talking about 12% below where the market is right now. There's various reasons for that. But I don't necessarily foresee a crash event, but one definitely jolts asset managers further into some other place to be.
Now, if gold is the general leading the charge, silver is the cavalry racing in just behind. And when it shows up, it doesn't just participate, it dominates. Anyone who's followed these markets for more than a few cycles knows that silver tends to lag in the early innings of a precious metals bull market. But once it wakes up, it's not playing catch-up. It's out for vengeance. Let's start with some context. As we mentioned earlier, we're currently sitting at around 1.13% on the silver to gold ratio using our preferred method of analysis. That's silver per ounce as a percentage of 1 ounce of gold. Historically, that's low. It's very low. In fact, it's below the long-term average of around 2%. And let me be clear, 2% isn't a moonshot. It's not some fantasy number, it's normal. It happened in 21 out of the last 50 years. So getting back there would not be some freakish rally, it would be a reversion to the mean. Let's say gold moves to $5,000. If silver gets back to just 2%, that puts silver at $100. That's not even an aggressive target based on historical performance. If gold makes a more aggressive move toward $8,000, something that is absolutely possible given the monetary distortions we're witnessing, you're looking at silver at $160 at a mere 2%. At 3%, which it hit in 2011, $240. And I say this not to pitch you a dream, but to contextualize what's already happened before and why it could happen again. Here's what you need to understand about silver momentum. It doesn't creep higher the way gold does. It erupts. When momentum in silver turns, it typically explodes, and it's usually in the latter stages of gold's bull run. We saw it in 1979 to 1980, when silver went vertical and briefly touched $50, while gold surged toward $850. We saw it again in 2010 to 2011, when gold rallied from $1,000 to over $1,900, and silver shot from $10 to $50, a 5-fold increase in 2 years. And today, once again, we're seeing early signs of that same coiled spring setup. The open interest in silver is ticking higher. The momentum indicators, both short-term and long-term, are suggesting that silver's been in a prolonged consolidation phase and is now poised to break out. Now, here's the important part. Silver isn't just a precious metal, it's an industrial one too. And with the rise of green tech, solar panels, electric vehicles, and even military-grade electronics, demand for silver is growing fast. The Silver Institute has reported that we're in the midst of multi-year supply deficits, and that's before speculative money starts chasing price. We're already seeing movement. In the last month alone, 17.5 million ounces of silver were transferred in New York from bullion banks to non-bullion banks. That's one of the largest transfers in COMEX history. Who are these non-bullion banks? That's the question. You're not talking about retail investors or even medium-sized hedge funds. These are sovereign wealth funds, family offices, and possibly central banks wearing a different hat. These are the smartest, most capitalized players in the world, and they're not just buying futures or ETFs. They're standing for delivery. That's a massive tell. Why? Because historically, nobody took delivery. For decades, COMEX was a casino where bets were settled in cash. Now we're seeing physical demand increase dramatically. That's a paradigm shift. And it's not just in New York. The London Bullion Market Association, LBMA, has been hemorrhaging silver. Last month, they suffered their largest monthly decline since records began, down 8.6% to 270 million ounces. Yet they're trading nearly 3 billion ounces per day in paper contracts. That's more than 3 times annual global silver mine supply, traded daily. You don't need to be a conspiracy theorist to see the issue here. That's a derivatives time bomb. If that leverage begins to unwind, and I believe it's starting to, you're going to see silver prices break free from decades of artificial suppression. You see, as Andy Schectman and others have pointed out, rehypothecation is the game. That's how they played it for years. 36 million ounces of physical silver standing against 380 million ounces in outstanding spot delivery contracts. That's over 10-to-1 leverage. And if even 10% of those contracts stand for delivery, the system could blow out. Which brings us to an even bigger truth. Gold and silver are being repatriated by serious players. There's a flight to safety happening, but not the kind the media talks about. It's not about treasuries or tech. It's about de-dollarization, de-risking, and definancializing portfolios. That's why central banks, who once were net sellers, have become net buyers. Why? Because gold and silver are real money, with no counterparty risk. And if silver is still the poor man's gold, it's about to become the middle class's last stand against inflation. When the mainstream finally catches on, when it's not just family offices and sovereign wealth funds standing for delivery, but also retail investors waking up, there simply won't be enough silver to meet demand. Remember, silver's total market cap is tiny, less than $2 trillion, and most of that is locked up in industrial use or strong hands. A mere $10 billion influx can shift silver from $30 to $60. That's not a wild prediction. That's basic math in a highly constrained market. And let's not forget about mining stocks. The miners have been treated like pariahs, trading at depressed multiples while minting cash at 2,500 plus gold and 30 plus silver. Most of these companies have lean balance sheets, strong margins, and no love from Wall Street. That's the perfect setup. Once institutions shift out of tech and into tangible assets, the miners will outperform both the metals and the S&P. And if silver goes vertical, some of these mid-cap miners are going to go 5x to 10x. Look, this is not about doom and gloom. It's about positioning before the crowd. If history teaches us anything, it's that the biggest moves come when the public is absent and insiders are active. Right now, the public is chasing Nvidia, Bitcoin, and call options. Insiders, they're dumping stocks, loading metals, and repatriating bullion. That divergence is the signal. To bring it full circle, silver is the most undervalued, misunderstood, and underappreciated monetary asset in the world today. It's cheap relative to gold, it's in deficit, it's becoming critical for industry, and it's about to get the monetary spotlight it hasn't seen since 1980. Whether gold goes to 5,000 or 8,000, silver is going to vastly outperform, and that move might have already started. So to our viewers and listeners, don't wait for the headlines. Don't wait for Goldman Sachs to upgrade silver to a buy. They'll do it after silver hits $75. Get in now, while sentiment is dead, while supply is tight, and while the insiders are still making their quiet moves. This is the moment where patience becomes profit. And if history repeats, and it usually does, silver's next leg higher won't just be sharp, it'll be historic.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.